Standard financial advice suggests that if you're young, single, and childless, you have no use for a life insurance policy. That logic ignores the reality of the sole economic engine. When you live alone, you are the entire economy of your household. You lack the backup income of a partner or a shared safety net, making your individual ability to earn the only thing keeping your household afloat. This compares 5 years of living expenses to a standard employer payout. Workplace insurance is capped at twice your salary, a fraction of the liquidity needed. Lacking portability, if a medical crisis forces you out of work, that safety net vanishes. The insurance model for a single professional focuses on two specific goals: protecting the engine while it runs and insulating the family members who helped build it if it breaks down. For a single professional, the most statistically likely catastrophic risk is a severe illness or injury that destroys the ability to work. Long-term disability insurance, or LTD, serves as the primary defense here. It is designed to replace 60 to 70% of your gross income, maintaining your standard of living while you are unable to earn. You must watch for any occupation clauses. These allow insurers to cut off benefits after just 2 years if they determine you can physically perform any job at all, regardless of your professional training. Critical illness insurance provides the second layer of defense. It triggers a tax-free lump sum, often between $50,000 and $100,000, immediately upon a diagnosis like cancer, a stroke, or a heart attack. This cash maintains your autonomy. It pays for rent or private treatment options, preventing a medical diagnosis from forcing you to liquidate your retirement accounts. Living benefits provide the maintenance required to keep the sole economic engine from collapsing under the weight of medical debt. In the event of a sudden passing, a single person's estate faces an immediate legal hurdle: the reality that personal debts do not simply disappear. Canadian law makes a clear distinction between debt types. While the government forgives federal and provincial student loans like OSAP, private student loans and professional lines of credit are normal liabilities that must be settled by your estate. Co-signed liabilities create the most immediate distress. If a parent or partner co-signed your mortgage or car loan, the law holds them entirely responsible for the full balance the moment you pass away. Leaving these co-signed debts uninsured shifts your financial obligations onto the people who supported your success, forcing them to pay for a tragedy they are already grieving. The cost of dying in Ontario is one of the highest in the country. A standard Toronto burial now averages $19,800, while the federal Canada Pension Plan death benefit provides a maximum of only $2,500. The bill grows through deemed disposition. The CRA treats your assets as if they were sold at fair market value on the day of your death, triggering immediate capital gains taxes on your final return. Ontario then applies the estate administration tax, a 1.5% probate fee on all estate values exceeding $50,000, which must be paid before your executor can distribute any inheritance. For incorporated professionals, business shares are also subject to deemed disposition. This triggers a capital gain that stacks on top of your final income, often pushing the estate into Ontario's top 53.53% marginal tax bracket. Corporate-owned life insurance provides the liquidity to discharge this massive bill, preventing the government from draining the business. Without the liquid cash provided by an insurance payout, an Ontario estate is often depleted by taxes and fees before loved ones see a dollar. Calculating your requirements follows a specific formula. Combine your private and co-signed debts with your final expenses, then subtract your liquid emergency savings. Most singles should avoid expensive permanent policies in favor of targeted term insurance. This allows you to match your coverage length to the specific amortization of your co-signed debts. Naming your co-signer as the direct beneficiary is a vital legal move. This routes the payout directly to them, entirely bypassing the frozen assets and 1.5% tax of the Ontario Probate Court. Buying your policy while you are young and healthy locks in lower premiums and protects your future insurability. This ensures you have coverage in place before health issues develop that could make insurance unaffordable or unavailable. Financial independence demands a self-reliant strategy, one that protects the engine today while securing the people who helped you succeed.